We analyze global politics, financial markets, macroeconomics, and digital assets, helping investors see tomorrow before the rest of the world. Welcome to Era of Changes.
The US Treasury is stepping into open warfare with the bond market, and legendary investor Stanley Druckenmiller is already sounding the alarm. Officials are trying to seize control of the price of the long-term dollar, and this decision could change everything. But what's actually happening behind closed doors? We're used to watching the Federal Reserve's meetings. Will there be a rate cut or not? What will the Fed chair say? But the real financial drama of the last few days isn't unfolding inside the central bank. It's happening next door, at the US Treasury. At the heart of it lies an old question: who sets the price of money, the state or the market? The answer used to seem obvious. Now it doesn't. On August 19th, the Treasury announced it was at least doubling the size of its buyback operations for long-term government bonds. The previous cap on a single operation was $2 billion. Now it's at least $4 billion. The main target is bonds with maturities of 10 to 30 years. The new regime takes effect on September 9th. At first glance, $4 billion is a small number for the US government debt market. That's true. But it wasn't the figure itself that spooked the market. What the market heard was something else. The Treasury no longer wants to just watch long-term yields climb. It's ready to argue with the market directly, and that's an entirely different story. To understand why this matters, let's look at what the Treasury is actually doing. When a government runs a buyback, it purchases its own old bonds on the open market. Usually this means off-the-run issues, which trade worse than newer ones, less liquidity, wider bid-ask spreads. The official logic is simple: pull some of these bonds off the market and make it easier to manage cash flow. The operation itself isn't money printing. The Treasury doesn't have the same printing press the Fed does. When the Fed runs quantitative easing, it creates bank reserves and expands its own balance sheet. The Treasury works differently. It buys back old bonds but finances the purchase by issuing new debt. One form of government debt is swapped for another. So calling any buyback stealth QE is technically wrong. But here's where it gets interesting. What matters isn't just the fact of the purchase, but which bonds the Treasury pulls off the market, how it finances the purchase, and what the goal actually is. The government buys back long bonds and issues short-term bills instead. It reduces the interest rate risk the private market has to carry. The supply of long bonds shrinks, their price gets support, and yields can fall. Money isn't necessarily being printed. But the price of capital is already starting to depend not just on free supply and demand, but on decisions made by the fiscal authority. That's why the market started talking not just about liquidity support, but about an attempt to manage the price of long-term debt. The timing matters too. The decision came after 30-year yields climbed to their highest levels in nearly 2 decades. Right after the news, yields did fall, but the effect didn't last. By the next day, the market had almost completely reversed the move. That's an important signal. It shows that even the world's largest sovereign borrower hasn't yet convinced investors it can change the fundamental price of risk by administrative decision. Why are long yields so dangerous for the US in the first place? Because the 30-year yield isn't just a number on a trader's screen. It's one of the key benchmarks for the entire financial system. Mortgage rates, corporate borrowing costs, real estate valuations, and fast-growing tech companies all depend on long-term rates. When yields rise, old bonds lose value. Banks and funds take losses. Mortgages get more expensive. Household purchasing power falls. Developers delay projects. Companies find it harder to refinance debt. And stocks whose value depends on profits many years out start to look less attractive. But for the government itself, the problem is even more serious. Total US government debt has passed $40 trillion. The budget deficit runs close to $2 trillion a year. Federal interest expense has crossed $1 trillion and keeps growing. That creates an ugly loop. A high deficit requires new borrowing. A large volume of new bonds pushes down their price. A lower price means higher yield, and higher yield increases both the cost of servicing debt and the future deficit. At some point, the market stops discussing the next Fed meeting and starts asking a less comfortable question. At what price is it willing to keep financing a government with no credible plan to stabilize its debt? According to the Congressional Budget Office, the US deficit in 2026 will run around $1.9 trillion. Debt held by private investors and institutions outside the federal government has already approached the size of the country's entire annual GDP. Here, I'd push back on a popular claim that foreigners have supposedly stopped buying American bonds altogether. That's an exaggeration. The world hasn't boycotted US debt. Foreign capital is still buying American assets. The problem is subtler. Buyers haven't disappeared. They're just demanding a higher price for the risk. And the gap between no buyers and buyers demanding 5+% is almost equally painful for the budget. For a long time, America enjoyed a unique privilege. Its bonds weren't just a way to borrow money, they were the foundation of bank collateral, currency reserves, and global trade. Investors accepted low yields because they got liquidity and safety. But that privilege doesn't mean the price of debt can be set at will. Supply outrunning demand, sticky inflation, a deficit that never shrinks. For each of these, investors demand compensation. And if the long rate starts being held down administratively, they'll demand compensation for one more risk, that the pricing mechanism itself loses credibility. A quick word on the Treasury's account at the Fed, the Treasury General Account, or TGA. It currently holds roughly $1 trillion. But it's not a war chest that can be spent into the market freely. It's an operating cash account the government uses to pay expenses and manage day-to-day liquidity. When the Treasury spends from this account, bank reserves generally rise, and to markets that looks like a wave of liquidity. When the Treasury borrows again and rebuilds the balance, the process runs in reverse. So a falling TGA balance can temporarily support financial assets. But a dollar that leaves the account isn't a dollar of permanent new wealth. If it's later pulled back through new bond issuance, the effect is temporary. There's no confirmation that the entire trillion has been earmarked for mass purchases of long bonds. What's been announced is a larger size for specific operations, not the drawdown of the whole account. The published quarterly refunding plan budgets buybacks of old issues up to $38 billion plus up to $25 billion in short-term bills. Meaningful sums, but nowhere close to $1 trillion. Still, the fact that the market is seriously discussing a much larger intervention says something about a crisis of confidence. Investors have stopped asking whether the government will intervene and started asking how far it's willing to go. It was against this backdrop that Stanley Druckenmiller, one of the most prominent macro investors of recent decades and a former colleague and mentor of Scott Bessent, spoke up. His criticism stings precisely because of that history. This isn't a political opponent. It's someone from the same professional world who understands Bessent's logic. Druckenmiller called the expanded buybacks a mistake and an attempt to manage price. His core argument is simple. A solvency problem can't be solved with a liquidity tool. If long yields are rising because trading in specific issues has gotten thin, buybacks can help. But if yields are rising because of the deficit and a huge future supply of debt, a technical operation doesn't fix the cause. It just mutes the symptom temporarily. Worse, it creates a risk of dependency. Muting that signal eases the budget's position temporarily but erodes confidence in the bond market itself. The Treasury has a strong counter-argument. The US debt market is so large that technical breakdowns in it are dangerous for the entire global system. Off-the-run issues really can become less liquid. Dealer balance sheets aren't infinite, and a sharp jump in yield sometimes reflects a temporary imbalance in positioning rather than fundamental fear. In that situation, the government needs stabilization tools, and against a multi-trillion-dollar market, the current expansion looks more like a targeted operation than a surrender of free price discovery. The question isn't whether buybacks are acceptable in principle. It's about intent. Is the Treasury fixing a liquidity breakdown or engineering a comfortable yield level? Acting on a pre-announced schedule or reacting to an uncomfortable market price? Reshaping debt for efficiency or shielding the budget from the market signal? The answer will determine what this program actually turns out to be, an ordinary debt management tool or the first stage of financial repression. By financial repression, I mean a system in which the government holds the cost of borrowing below the level that would form freely, by buying more long bonds, issuing more short-term debt, and pressuring the central bank toward looser policy. On paper, there's no default. Every obligation gets paid in nominal dollars, but the real value of those dollars gradually erodes through inflation. Which brings up a familiar phrase. The system chose inflation over default. I'd put it more carefully. The final choice hasn't been made yet. But the system has taken another step towards solving its debt problem through negative real yields and the gradual debasement of money rather than through a hard cut to the deficit. What does this mean for markets? First, the dollar's path will be bumpy. During an acute crisis, it can still strengthen as investors seek liquidity, but over a longer horizon, persistently suppressing yields against a high deficit undermines its real appeal. Second, not all Treasury bonds have stopped being safe. A short bill and a 30-year bond are completely different instruments. The long bond's price can fall sharply even without a formal default if the market demands a higher yield. Third, if liquidity expands, risk assets can get a strong boost. Stocks, gold, and crypto often respond to falling real rates. But if the intervention is read as a loss of control over inflation, long yields can keep rising and expensive stocks can come back under pressure. Fourth, hard assets take on added strategic weight. Gold, commodities, and businesses with pricing power protect capital better than a long fixed promise to pay the same dollars 30 years from now. Crypto can also benefit from distrust in the fiat system, but in moments of liquidity shortage, it can fall faster than traditional assets. So the biggest mistake right now would be swapping one dogma for another. The old dogma was believing US debt was safe at any price. The new dogma could be believing that buying gold and Bitcoin is enough to automatically profit from any crisis. Markets are more complicated than that. Over the coming months, I'll be watching 5 things: whether buybacks stay small and pre-scheduled or start getting bumped up after every yield spike, what kind of debt finances these purchases, how quickly the TGA balance falls, how yields behave after September 9th, and whether the Fed keeps fighting inflation independently or starts accommodating the federal budget. In the first scenario, the Treasury sticks to technical liquidity support, the market calms down, and talk of stealth QE turns out to be overblown. In the second, buybacks keep growing, the debt mix shifts toward the short end, and the Fed moves toward looser policy. We'd see a fiscal equivalent of QE. In the third, the market simply doesn't buy it, yields stay high, and the government is forced to choose between genuine fiscal reform and a far larger intervention. For now, the market is voting skeptically. The initial reaction to the announcement faded fast. That doesn't mean the Treasury is powerless. It means the current expansion can't close a hole measured in trillions. So this story is much bigger than one decision by Scott Bessent. What we're watching is a fight over who gets to set the single most important price in the global economy, the price of the long-term dollar. That price used to be set by the market. Increasingly, the government treats it as a variable it can manage. But the bond market isn't like an ordinary political opponent. It can't be talked into changing its mind. It just sends the bill, and the longer the underlying cause goes unaddressed, the bigger that bill gets. So I'm not claiming treasuries will stop existing tomorrow or that the dollar will collapse overnight, but the old model where a government can keep expanding its deficit indefinitely while still counting on cheap long-term financing is starting to break down. The system hasn't picked a final path yet, but the fork I mentioned at the start is now clearly visible. Either the US rebuilds trust through fiscal discipline, or it keeps trying to hold down the cost of debt by administrative means and gradually pays for it through inflation, market distortion, and a weaker currency. That's exactly why capital management strategy needs rethinking, not once the printing press is officially switched on, but the moment a government first starts arguing with the price of its own money. That argument has already begun.
Our weekly trading results. Join for free, subscribe, and get early access to forecasts.